Really nice to be here. So I'm happy to share with you some work that we are doing to try to understand financial decision making in older age. And so this work really came about in a precipitous or just really out of nowhere. So I'm a clinical neuropsychologist by training. I've always had interests in early dementia and signs of early dementia, the earliest signs from a cognitive standpoint. And so I started, in addition to those research interests, I was seeing patients in clinic for presumed early dementia diagnoses. And so there was a point in time where I started seeing patient after patient where that was referred for a dementia evaluation because it was discovered they were giving away large sums of money either to bogus charities or strangers. And this was clearly a change of behavior. And the family members and caretakers thought, well, we should get a diagnosis for this and do something about it. And in case after case, I remember giving hours of cognitive testing and they would test normal, actually. And so this was frustrating to all the care providers and family members. The patients often loved it, actually, because it just gave them license to keep doing what they're doing. But in my mind, as a research-minded clinical neuropsychologist, I was trying to understand why we were having this sort of mismatch between a clear change in behavior and not being able to pick up on it on our usual cognitive tests. And so that started really a program of research trying to understand financial decision making as a potential early precursor to dementia and even ahead of any noticeable cognitive or typical cognitive change. So with that, I'll just say I don't really have any financial disclosures. As Emily mentioned, I'm the editor-in-chief of a journal. Not that that impacts anything that I'll be talking about. But in terms of background, older adults over the age of 65 hold a third of the nation's wealth, and this is based on estimates from David Leighton, who is an economist at Harvard. This was based in 2011 on 2011 estimates, and so it's likely more than this is held by older adults over the age of 65. But we also know a portion of older adults, not all older adults, but a portion of older adults unfortunately become the victim of scam or fraud. This report that came out last year in December from the FTC has noted that this has increased in ages 60 and over. Some estimate this to be about $30 billion annually. I've seen a recent estimate in the $70 billion range. So it's a major problem for some older adults. We know that as we grow older, our brains change. And so these are all the brain areas in yellow that change, that tend to decline as part of normal aging. Of course, you can have abnormal aging, and this could have a significant impact on function. However, I also like to remind people that this picture is very heterogeneous. So these are four areas of the brain that show declines at the individual level. And you can see some areas of the brain are this direction is more clear. However, other areas of the brain it's a little bit less clear. And in fact, if you look at the individual level, there are some individuals that show increases in brain. And so it's really a heterogeneous picture. But generally speaking, as we lose brain, our cognition goes down. And I think most people understand that. However, cognition is not a uniform construct. There are lots of cognitive abilities. And we know from very great work from Denise Park that some of these abilities will increase with age. For example, the ability to acquire knowledge over time is something that will increase with age, while others will decrease with age. But there was an article as I was starting to see these patients in my clinic and scratching my head that came out from the New York Times at about the same time. And this was an article that was not an empirical study, but what they did was this investigator interviewed a number of different family members who noted that financial decision making was the first sign that something might be happening, such as a disease or a dementia process. And so I was a part of the Rush Alzheimer's Disease Center at the time, also in Chicago, and this is something that really caught a lot of our interest, and that started a whole program of research trying to understand financial decision making as an early sign of dementia. Now I'm going to fast forward to a recent article that came out in JAMA Internal Medicine from Lauren Nicholas, which is something that is highly cited now in our field. But basically what she did, which was brilliant, was she merged Medicare data with credit scores or credit data, actually. And this was in over 50,000 adults. And what you can see is that ahead of a dementia diagnosis, people actually started showing subprime credit scores, actually, or missed credit payments. And this is actually very perceivable about 2 years before diagnosis and even detectable up to 6 years ahead of diagnosis. So this really, I think, is one of the most compelling pieces of evidence to suggest that financial decision making might be an early sign of dementia. But as I said before, I was a part of an Alzheimer's disease center that had an interest in this, and so we did do a number of smaller studies looking at the condition mild cognitive impairment, which is commonly thought of as a precursor to dementia. And this is a condition where older adults are showing some signs of cognitive impairment, but are functionally okay or able to get by. And what we found was that people with mild cognitive impairment did actually perform worse on a measure of decision making, a financial decision making, healthcare decision making, on a measure of susceptibility to scams that was developed. And I'll talk a little bit more about this later. And then what we did was we actually use a different measure of decision making in a clinical trial that was happening in Indianapolis, Colorado, and San Diego, and actually saw again the same finding, essentially, that older adults with mild cognitive impairment actually performed lower on various decision making measures and considerations. However, this is not just about what we call cognitive ability. And I mentioned before, and I started my talk with these cases that I would see in clinic, where there was apparently intact cognition, quote unquote, but they were making poor financial decisions, and this was a change in behavior. So we wanted to look at this to see how many individuals might be showing this in a group of non-demented older adults, a large group of over 600. And what we found was that there were a number of older adults who showed poor decision making relative to their cognitive ability. And these are all the examples in green here. We saw the majority of older adults showed decision making within range of their cognitive ability, and those are all the instances of blue. What's interesting is that we also saw some older adults who showed decision making ability better than their cognitive ability, and these are instances in red. But overall, the main idea here is that there are individuals that actually show a difference or discrepancy between their decision-making ability and their cognitive ability. And so the question comes at how can we understand this? If an older adult is showing poor decision-making relative to their cognitive ability, how does that happen? What is with that? I think most people would understand that if someone's experiencing cognitive impairment, they're going to actually perform worse on financial decision making. But this idea that people might be cognitively intact, quote unquote, but showing poor financial decision making is a bit of a puzzle. One way that we've tried to understand this is using brain imaging. And so we know that from seminal work at the NIA that the brains can change and are measurable. That change is years ahead of any noticeable cognitive impairment. And so this is something that we've used. It's one of the many tools that we use to try to understand this question. And so some people think that this is considered a neuroeconomic approach. And so this is just a few words on what that means. I just want to be the first to say that I don't necessarily count myself as a neuroeconomist because I think they're much smarter than I am. So, but essentially, this is the sort of theoretical backdrop to the Beeson Career Development Award, which is a great mechanism, and I highly recommend it. And David Bennett, who's the director of the Alzheimer Center at Rush, was my primary mentor, and there were lots of mentors actually around, across the country. So I just wanted to acknowledge them with that previous slide. So one of the things that we think of, or at least we've thought of when thinking about this question, is the importance of age-associated neuropathology. And so I just wanted to take a bit of a side sort of explanation about what we mean by this. So basically, when most people talk about cognitive decline, they show a single line for essentially representing a sample showing a decline in cognition. However, as I mentioned before, there's a lot of heterogeneity that needs to be considered with that single line. So what if we were able to see at the individual level people's change in cognition over time. It actually looks like this. So this is actually a lot of up and down. There's just a lot of messy sort of trajectories here, right? It does seem to go down particularly close to death, and zero represents death here. But there's just a lot of heterogeneity here. And so, what if we actually statistically remove the impact of age-associated neuropathology? So, statistically remove the impact of amyloid, tau, TDP43, microvascular changes. If we statistically remove those things, what does it look like? What does cognition look like with respect to age? It actually looks like this. It's a relatively stable, non-changing line. There's a little bit of change close to death, actually right before death, but otherwise it's pretty much just a straight line. And so this is work from Bob Wilson at the Rush Alzheimer's Disease Center, and this is something that I think helps a lot of us understand the importance of age-associated neuropathology, and really any sort of late life cognitive loss or change might reflect just non-normative pathological or mortality-related processes rather than normative age-related processes. So it's not that age necessarily causes cognitive decline, it's the age-associated neuropathology that causes the cognitive decline. So we know that age-associated neuropathology also has an impact over years. And so this is something that can be perceived in cognitive decline up to 20 years before an incident mild cognitive impairment. We also know that age-associated neuropathology impacts very specific brain regions. And what's interesting is that the brain regions that are implicated in decision making, which are highlighted here in this Peters and Buchel review, are the same ones that are actually susceptible to age-associated Alzheimer's neuropathology, actually based on how we know that amyloid plaques distribute through the brain and impact the default mode network. And so basically, not a lot of people have been putting these two things together in the field. And what we're trying to do is actually say, look, the same brain regions that are susceptible to age-associated neuropathology are the same ones that are involved in decision making, and that could help explain what's going on and why financial decision making might be one of the earliest signs of Alzheimer's dementia. So I'm going to break this down in terms of the brain regions that we think are involved. And so if we think about brain regions involved in decision making, these include the ventral medial prefrontal cortex, the insula, the hippocampus, posterior cingulate, anterior cingulate, basal ganglia, and orbital frontal cortex. We know that in particular, the ventral medial prefrontal cortex, ACC, PCC, and the hippocampal complex are very susceptible to age-associated neuropathology. What's interesting is that the posterior part of the default mode network is actually something that subserves episodic memory and prospective memory, which is the ability to imagine future outcomes based on past experience. We know that the anterior cingulate is very involved in executive functions, processing speed, and it has very strong connections to the insula, which is involved in gut-based decisions. And then the ventral medial prefrontal cortex is very involved in value decisions. And so these support reward valuation and anticipation and emotion-based judgments. These regions are implicated in lots of different decision-making paradigms, but the ventral medial prefrontal cortex also has a lot of connections to the other parts of this network. Now, one specific word about the insula. The insula is particularly impacted, we think, through the multiple connections to these other brain regions. And the insula is an important decision-making region. And so we think it's secondarily impacted because of all these connections. So this is our working model now, where neuropathology impacts neural systems. These impact cognition and behavioral economic preferences. And this could actually lead to financial vulnerability, which in time could lead to cognitive decline and dementia. So we've done a lot of neuroimaging work today, and I'm not going to cover all of these for the purpose of this talk, but I'll just highlight a few things. One is that we have a measure of temporal discounting that we've been using, and temporal discounting is a behavioral economic preference where it measures how willing someone is to accept the smaller reward at an earlier time instead of a larger reward at a later time. And so an example of this is, say I offer you the option of taking $5 now or $5 million an hour from now. You just have to wait the hour. Most people will wait the hour because $5 million is a lot more than $5, but some people might just take the $5 now. And we consider that a poor choice in that case. And so you can parametrically vary the amount of money offered and the time that this is offered, and actually look at individual parabolic functions essentially in terms of their temporal discounting. What we found essentially was that older adults who were completing a temporal discounting task, who took the more immediate reward, had greater functional connectivity of the ventromedial prefrontal cortex, and older adults who took the later reward, the larger reward, the better option, had greater connectivity of the parahippocampal gyrus. And so essentially what this means, or what we think, is that these brain decisions essentially that are happening are explainable by these brain mechanisms that are perceivable with neuroimaging. We also saw that generally greater structural connectivity in the brain is associated with better choices in this temporal discounting measure using diffusion tensor imaging. In a different measure that we use called, that we refer to as susceptibility to scams. This is a measure that was actually developed by Dr. Patricia Boyle at Rush, and this was based on the work of AARP and the FINRA organization, the Financial Regulatory Authority, where they interviewed older adults who have been the victims of scam or fraud. And you can see a lot of these items are actually, I think, ecologically very related to the idea of susceptibility to scams. So, for example, the first item is I answer the phone whenever it rings, even if I do not know who is calling. So if an older adult is actually answering a phone, whenever it rings, no matter who's calling, they're going to be more susceptible to scams. So what we did was we actually looked at this measure, see how people actually responded to it, related it to brain imaging. And this was a surprising finding, but what we saw was that less gray matter density in non-demented older adults in the right hippocampus was related to greater susceptibility to scams. So these are older adults without dementia. They're not showing significant cognitive impairment, but we saw less gray matter density in the right hippocampus, which we know is susceptible to age-associated neuropathology, showing greater susceptibility to scams, or associated with greater susceptibility to scams. And this is in models adjusting for age, education, sex, and global cognition. So, and that global cognition variable is a composite of 19 different cognitive tests. So this is over and above general cognitive ability. We're seeing these associations. Just like before with temporal discounting, what we found was that less structural integrity in the brain was associated with greater susceptibility to scams in older adults. And so this is what is being shown here. Okay, so this is the part in the talk where I usually acknowledge there needs to be a discussion about limitations. And so a lot of the images that I showed were a cohort in Chicago. They're compelling because they're brain images, but you know, in order to be a good scientist, we can't really call something true until it's seen in other different populations and other different labs. A lot of what I just presented is some of the first work in this space using brain imaging. And so I just wanted to acknowledge that. So we need to see these same associations replicated in other labs, other samples, before we run ahead with how robust they are. Some additional thoughts. So as I was doing this work, what's interesting is that I was very not impressed with the diversity of participants in the studies. A lot of behavioral economic and aging neuroimaging work in Alzheimer's had very little representation of participants. We know older Black adults are 2 times more likely to develop Alzheimer's disease. Older Hispanic adults are 1.5 times more likely to develop Alzheimer's disease. And the imaging work was not reflecting this, actually. We also know that there are racial differences in cognitive and affective factors that might impact decision-making. Racial differences are, I think, understandable based on cultural differences in decision-making, and no one was really considering this at the time. We also know that contextual factors, so the ability to access or develop financial literacy, is something that's really important for optimal financial decision making. But we know historically, certain groups have, due to institutionalized racism and unequal access to supportive resources, have been unable to develop literacy, to develop that knowledge base that could help optimize decision making. We also know that socioeconomic status is a very important consideration in how brains develop, actually. And so this is something that caught my attention. I was a part of an Alzheimer's center at the time, and I started sharing some of these concerns with people. Ed Young, who is a Pulitzer Prize winning author, who received the Pulitzer Prize for his COVID reporting, actually reached out to me, and a few others, because we started saying this publicly, essentially, that it's concerning that our research samples are not reflecting the community, essentially, and it really calls into question how robustly we can generalize some of these findings that are being put forth. This is a great article. There's a lot smarter people in this article than me. I'm just happy to be a part of it, but I just highly recommend it for anyone who might be interested in it. But essentially, this became the idea behind an R01 grant that we wrote to try to understand racial differences in decision making among older adults. And this was with Dr. Lisa Barnes, who is at the Rush Alzheimer's Disease Center, and she has dedicated her life's work to understanding cognitive decline in older African American populations. And so I'm just going to highlight a few pieces of work from this. So one is that we found that literacy mediates racial differences in financial and healthcare decision making in older adults. So as I mentioned before, the ability to develop literacy, financial literacy, makes a big difference in how people perform on these financial decision-making tasks. And what we found was that literacy completely mediates the association between racial differences in racial differences in decision making. So literacy completely erases any sort of racial difference in decision making once that's considered. We also looked at susceptibility to scams in older Black and white adults. In some of the circles that I've been in, there's an understanding essentially that older minoritized adults actually experience more scam or fraud. And what's interesting is that some people, in my opinion, make an erroneous assumption that older minoritized adults are more susceptible to scam or fraud because they experience more scam or fraud. And this is something I never really believed, actually. So this is something we took some time to systematically study. And if anything, older Black adults are less susceptible to scam or fraud based on the measure that was developed. Why are minoritized adults experiencing more scam or fraud? It's because they're being targeted more, or at least that's what we think. Um, I up until this point, I had been talking a lot about brain imaging. I have been talking a little bit about cultural considerations, racial difference considerations. Really, there's a lot of different factors that go into decision making. So, if you could think of yourself when you're trying to think about whether or not you should buy something, there's a lot that goes into that. There's the memory of previous experiences of buying. There's your emotions behind buying that thing. There is history. There's consideration of others. There's a lot of different factors that go into decision making. It's really a multifaceted, multivariable construct, and it's been really hard to study for that reason. But one of the things that we've tried to do is actually try to talk about all the different factors that might be involved in differences in decision making. And so this is Mark Lax. He is the head of geriatrics at Cornell University in New York City. And he and I met for the first time a few years ago, a number of years ago at this point, and we both bonded on the fact that we were seeing these patients in our clinic that puzzled us. They were apparently cognitively intact, but they were showing changes in their decision making, actually. And so he is a geriatrician in New York City. I, at the time, was a neuropsychologist in Chicago. We were seeing this in our clinics in two different disciplines. And he thought, well, maybe we should just write about it and just call it something so that we could study it and try to understand it. And so that's where this idea of age-associated financial vulnerability came about. And so we wrote this piece for the Annals of Internal Medicine. And here we really just developed or thought of some factors that could impact this or lead to understanding about this. Um, According to cognitive factors, medical and functional factors such as progressive illness or disease, psychosocial factors, things like social isolation, environmental factors, so things like wealth concentration. And we just tried to understand this from a lot of different perspectives and mechanisms and explanations. And this is really just a theoretical paper that we thought we could then try and use as a basis to try to study this phenomenon. So fast forward to our lab at USC. My lab at USC is focused on trying to understand financial exploitation vulnerability in older adults and what are all the factors that go into this, not just the biological, not just brain imaging or cognition, but social factors, environmental factors, health factors. We're really trying to be as thorough and as broadly considering as possible. So yeah, this is something that is a project that's clearly ongoing. But I wanted to highlight some of the work that we've done. One is, and this is Gali Weisberger, who was a former fellow and is now a tenured professor in Israel. Here, in early work, we found that older adults who have experienced financial exploitation compared to adults who haven't reported greater symptoms of depression, greater symptoms of anxiety, and worse sleep problems. Um, this is Dr. Jenna Axelrod, who is a former fellow who left and then ended up coming back to the area and is now working full time in our lab. But she found that older adults who have been the victims of scam or fraud had higher frailty indicators compared to older adults who had not. Um, and this is Dr. Annie Wen, who is a associate professor at UCSD, and she is our qualitative researcher, co-investigator, who is interviewing all of the older adults in our study that have been the victims of scam or fraud. And this has been really interesting work. We know that we're not able to cover all of the different factors that explain financial exploitation vulnerability just based on our current methods. And so it's been really fruitful to understand when these situations happen to older adults, what are other things that we're not considering at the moment. Um, this is Dr. Aaron Lim, who also is a former fellow and also ended up coming back and working with us as a staff scientist. And he, during the COVID pandemic, we had to shut down everything. We couldn't actually do our face-to-face data collection. But what we did was we ended up checking in with people every 2 weeks through a cell phone, actually, and giving a number of different measures or considering a number of different things. And what he found here was that interpersonal relationship quality predicted financial exploitation vulnerability 2 weeks later and up to 24 weeks later. So we followed our participants every 2 weeks for 6 months and just checked in with them and asked, how are your interpersonal relationships? And measure their financial vulnerability. And it's been an interesting lockstep relationship, where as interpersonal relationship quality increases, their financial exploitation vulnerability decreases, and then vice versa, actually. So interpersonal relationships is an important consideration, I think, in financial vulnerability of older adults. We are doing brain imaging in older adults in the Los Angeles area. What's nice is that we are seeing the same results that we saw in Chicago also bear themselves out in Los Angeles. So this actually helps to establish reliability of what we're seeing and makes us feel a bit better about that. One of the studies that got a lot of attention was this study, again led by Dr. Gali Weisberger, and this is in collaboration with Dr. Anya Samek, who is an economist at UCSD. And what we did was we developed a behavioral economic preferences battery. And one of the measures is this measure of financial altruism, which was envisioned as a control measure for dictator games, which where someone is interacting with someone in terms of financial matters. This is a single question where we tell people that there is a random stranger online and they are given $10 and they can give any amount of that $10 to that stranger online if they want, but they don't have to. And I remember telling Anya, there's no way anyone's going to do this. Like, why are we even doing this? No one's going to give, money to a random stranger online if we're just that like upfront about it. Lo and behold, there was range actually in our non-demented older adult sample. And in fact, what's interesting is that older adults who gave more to that random stranger online ended up performing worse in a stepwise fashion um, on neuropsych measures that we know are particularly sensitive to Alzheimer's disease. So they're not performing in the impaired range yet, but you can see here it's literally a stepwise fashion. The more that they gave money to that random stranger online, the worse that they performed on these very specific neuropsych measures that we know are predictive or sensitive to Alzheimer's dementia. So this was pretty surprising to us, actually, to see it so clearly laid out like this in such a simple question, actually. And so, yeah, it's been interesting. Um, a current graduate student, Dr. Daisy, or not a doctor yet, but Daisy Noriega, actually did this really nice study showing that it's not about how many friends you have, it's about how deep friends you have. And it's the depth of relationship that seems to be protective of older adults when it comes to financial exploitation vulnerability. And a very recent study just published from a first year graduate student, Melanie Leguizamon, showed that older adults who are able to cognitively reappraise are actually less financially vulnerable in older age. And what that means is that if an older adult is able to picture a different way of thinking about something or a different perspective of someone, they are less financially vulnerable in older age. And so what's nice about this is that it could actually lead to potential interventions where we might be able to test and measure something like this. So a lot of this work is involved in or involves financial exploitation of older adults. And I learned a lot about elder abuse actually from Dr. Laura Mosqueda, who's pictured here. She is the former chair of family medicine at USC and was the one that recruited me actually to USC. And in an elder abuse world, they not only consider vulnerabilities of the older adult, but also the person committing the abuse and the context in which it happens. And generally speaking, there needs to be an understanding of all three of these things in an abuse situation. So up until this point, I had been talking about the vulnerability of older adults, but really we're trying to also trying to understand what causes that trusted other to financially exploit, and also the contextual factors that could exacerbate this. These are some main points so far. So age-related cognitive decline can make an older adult more susceptible to scams. Although poor cognition is associated with poor decision making may not be solely due to poor cognition. A complex network of brain regions is susceptible to age-related neuropathology, might be involved in poor decision making in older age, and might help explain why certain older adults might start making poor financial decisions ahead of any noticeable cognitive impairment. More research needs to be done with diverse samples, and we need better measures of financial exploitation vulnerability or poor financial decision making. We have an ongoing study that's funded by an R01 where we're trying to understand these factors, and a lot of what I presented to you is actually from that ongoing study. We had a recent study that got a lot of attention, and this is a study from a former graduate student who just became a PhD, Dr. Laura Fenton. And here she found that lower entorhinal cortex thickness is associated with greater financial exploitation vulnerability in cognitively unimpaired older adults. Why is this important? It's because the entorhinal cortex is commonly thought of as the first brain region that's affected by Alzheimer's disease. And not only that, the entorhinal cortex connects the posterior default mode network, which helps us imagine future outcomes to something, to another brain network in the anterior default mode network, which helps valuation to make value judgments about something. So you can imagine a brain region that helps connect these two different subsystems, the ability to assess value and the ability to imagine future outcomes, is actually going to be very important for optimal financial decision making. And if that falters, then you might have poor financial decision making. USC, or I'm sorry, USC, CNN actually ended up doing a bit of a feature story on this, which is only a couple minutes long. And so I'm going to go ahead and try and play that next.
Researchers at the University of Southern California believe there may be a new way to spot Alzheimer's disease in its early stages.
Brain regions that are affected early in Alzheimer's disease are also involved in financial decision making.
Before she died, Jim Clunder's mom, Joan, was showing signs of Alzheimer's, but her decision making skills around money fell apart years earlier at a huge cost to the family.
If you wanted to estimate how much she was scammed out of her own pocket, my guess would be close to $100,000.
Researchers say they may have found a link between money matters and Alzheimer's. The part of the brain called the entorhinal cortex is a relay station between the hippocampus, which draws on experiences, and the medial prefrontal cortex, which values judgment and decision making. The entorhinal cortex was thinner in individuals who were more likely to be victims of financial exploitation.
Entorhinal cortex is also the brain region that is affected very early by Alzheimer's disease pathology.
This is something that helps explain why certain older adults may test cognitively normal, but may be showing poor financial decisions. And if this is happening, then I would encourage people to pursue resources on behalf of the welfare of the older adult.
Clunder said his mother had once worked with top executives and even presidents. So when she started making strange payments, he realized something was wrong.
She would never replace windows in her house that didn't need replacing, or buying a new refrigerator when she didn't need a new refrigerator.
Jim decided it was time for his mother to move to Pennsylvania and live with him. The week before Clunder's mother moved in with him, she bought tickets to go on a cruise to Europe instead. She also visited an ATM and went missing overnight.
So she was gone from 3:30 in the afternoon till noon the following day, until someone found her. She stopped at a drugstore and bought a blanket and slept in her car. And that's just not her. The more you're around them, the less you remember them the way they were. And it's hard.
Cameron Huddleston's mother, Winky, started making strange donations in the early 2000s. She was diagnosed with Alzheimer's in 2008, and a few months later, her daughter caught her talking on the phone with scammers.
I had to stay there and protect her. If she was healthy, she would have said, I didn't enter any sweepstakes, goodbye, and just hang up the phone. But I couldn't convince her that it was a scam. I wasn't thinking about how her financial decision making was impaired. And so it was a wake up call for me.
It's not that everyone who makes poor financial decisions will develop Alzheimer's disease. It's not that all people who have Alzheimer's disease will show poor financial decision making early on. Alzheimer's disease is a very, very heterogeneous disease, and it presents in a lot of different ways. But these are just some signs to look out for. Okay, so let me see. Okay. So following up on that work, actually, Laura found that looking at financial altruism again, that just in the hippocampus, you can actually see, again, this stepwise relationship but in particular in participants with income less than $100,000. So it does seem to make a difference. Again, the socioeconomic status, that the framing essentially from which someone is coming from. So this measure might be more sensitive to for people who are coming from lower socioeconomic status versus higher. And that makes all the sense in the world because they're using a measure of $10 essentially, or they have a $10 amount of money from which to make a decision. We have actually increased this amount in more recent applications of this measure, and that work is ongoing. I did want to say, as one of the things that has come from this work is the privilege of being a part of a number of different networks that are trying to do something about this. And so, as was mentioned before, I am a co-director of the Scientific Research Network on Decision Neuroscience and Aging, and this is a brand new network that was developed and funded by the NIH, NIA in particular, to try to really bring in decision neuroscience researchers and to have them focus on the aging brain more. And so this has been a privilege. One thing that I work with Dr. Emily Ho on is the ARMCADA project, and this is advancing reliable measurement and cognitive aging and decision-making ability. And what we're doing is trying to develop and come to a consensus on a measurement approach that could be used in larger studies to try to understand these things better in older age. I'm also a part of this Omni ADRD mission, which is essentially trying to advance open and accessible measures for brain health from a digital, mostly a digital context. And the idea being if we can try to identify measures that are sensitive to very, very early Alzheimer's disease, even in midlife, then this could be helpful for prevention. And I mentioned public policy considerations in the title of my talk, and this has been something that I've been really caught off guard by, or in a just really it's been interesting. I find myself in a lot more public policy circles these days, and there are people that are involved, for example, in elder abuse and trying to prevent elder abuse. There's a lot of really great interest from the Department of Justice to try to address this. There are legal implications of a lot of these things that we're trying to study, and so I've been involved in more legal circles. But just to flush this out a bit, I was invited to give a talk at NIH on this early on in my career, which was actually a career highlight. At that talk, the chief public policy officer from AARP invited me to be a part of the Global Council on Brain Health, where we have been trying to really develop ways that older adults can maintain or improve their brain health and really try to focus on particular issues that might be either helpful or harmful. I've also given a talk on Capitol Hill to the Social Security Advisory Board, which advises members of Congress on Social Security. As you might imagine, they might be interested in how this might impact policy. The Department of Justice, as I said before, are very interested in preventing elder abuse, and so I've been invited to give a talk there. I've been a part of a few different efforts now based at Harvard Law School that are interested in trying to understand how this might impact or might play itself out in legal implications. I do a lot of talks on behalf of the FTC and FBI, who are again trying to address fraud, elder fraud. And the FINRA organization, which is the Financial Regulatory Authority, has also been interested in this work. The National Bureau of Economic Research has a working group trying to understand the financial and economic decision-making impact of Alzheimer's disease. And actually, other countries are interested in this as well. I was invited to give a talk in Australia because they have a very well-established pension system. And so they were trying to understand how this might impact essentially their population, which is growing older. More recently, I've been involved in this MIT Age Lab project, which is trying to understand the early financial toll of dementia. And this is supported by AARP as well. So I'm finding myself increasingly in these public policy circles and just trying to share information that might be helpful. I don't really have any clear sort of, guidelines yet, but I think this is something that, as I mentioned, is becoming a bigger issue as time goes on. So some final thoughts. One is that we really view financial vulnerability as a spectrum. So there's not really a clear, solid line when an older adult becomes, not able to handle their finances. In fact, our default, our sort of baseline is that we want every older adult to maintain their health, well-being, and independence for as long as possible. So we are generally an advocate for older adults to retain rights as long as possible. So we see this as a spectrum, and it's not a clear black or white line. Some in the legal world actually, or in the justice world, want it to be a line because then it makes things like prosecution easier. But we really do see it as a spectrum. Also, we really see this as an intersectional model. So as I said before, older adults can have a number of different risk factors. They can have Alzheimer's disease, neuropathology, cognitive decline, medical illness, frailty, medication effects, which I haven't talked about yet. All of these can intersect and actually essentially contribute to a risk profile for an older adult to make a particular older adult vulnerable to financial scam or fraud. Or you might have an older adult that doesn't have any of those things, and you might have a very aggressive perpetrator that essentially just comes in and takes advantage of a situation and knows how to take advantage of a situation. We are seeing this a lot more with AI and people leveraging AI and other methods to just aggressively try to scam and fraud older adults. And then there's the contextual factors. So we recently came out of a pandemic. There's these socioeconomic disparities, cultural factors. We really need to understand how these cultural factors impact this intersection here to try to understand what are the factors that make a particular older adult vulnerable and what we can do about that. So with that, I will end by giving a number of acknowledgements to my lab and collaborators around the country and the funding and support from the National Institute on Aging, which we could not do any of this work without. Honestly, it takes a village to do this work. It's highly multidisciplinary work, and I'm just very privileged to be working with all of these great people. So that's all I have. So I will just go ahead and stop sharing. Thanks, everyone.